On a crisp Monday morning, September 15, 2008, the financial world was jolted as Lehman Brothers filed for Chapter 11 bankruptcy protection, marking the largest bankruptcy filing in U.S. history with more than $600 billion in assets. The sheer scale of the collapse raised immediate questions about how a firm once considered a Wall Street titan could crumble so dramatically. What hidden pressures had been building beneath the surface of this venerable institution? Lehman's balance sheet revealed a staggering $680 billion in assets supported by a mere $22.5 billion of firm capital, creating a leverage ratio that had swelled from roughly 24-1 in 2003 to 31-1 by 2007. This extreme leverage meant that even a modest decline in real estate values could erase the firm's capital entirely, exposing the fragility of its financial structure. Could such a precarious position have been a ticking time bomb? The firm's aggressive borrowing to fund investments had left it heavily exposed to subprime and lower-rated mortgage tranches, and a $2.8 billion loss prompted a desperate attempt to raise $6 billion through a new share offering. Yet the market's confidence evaporated, with Lehman's stock tumbling 73% in the first half of 2008 as credit markets tightened. How far could the firm push its capital-raising efforts before the market finally shut the door? In early September, the firm announced a 6% workforce reduction, about 1,500 jobs, just before its third-quarter reporting deadline, a move that underscored the escalating crisis. Simultaneously, its share price plunged 45% to $7.79 after South Korean investors halted talks, and slid another 7% following a $3.9 billion loss announcement. These rapid declines signaled that Lehman's options were narrowing fast. What would happen when its primary source of daily funding vanished? The turning point arrived on September 11, when JP Chase halted the more than $100 billion Lehman had been borrowing daily via the interbank market, effectively cutting off its lifeline. In response, the Federal Reserve, through JP extended $138 billion in advances, $87 billion on September 15 and $51 billion on September 16, to keep the firm afloat temporarily. Yet these emergency funds could only delay the inevitable. Would the infusion be enough to stave off collapse? Amid the scramble, Lehman entered talks with potential buyers, including Bank of America and Barclays. While Barclays initially seemed poised to acquire the core business for $1.3666 billion, the New York Times reported on September 14 that the UK's Financial Services Authority refused to waive the shareholder approval rule, effectively ending the bid. This regulatory roadblock left Lehman with dwindling options. Could any other suitor step in before the deadline? Barclays ultimately agreed to acquire Lehman's core business for $1.3666 billion, absorbing $47.4 billion in securities and assuming $45.5 billion in trading liabilities, while leaving behind $20 billion of securities assets. The deal also excluded Lehman's Eagle Energy unit but retained several regional subsidiaries and a private investment management arm. This partial sale reshaped the remnants of the fallen giant. How would the remaining estate manage the massive fallout? Across the Pacific, Nomura Holdings announced its acquisition of Lehman's franchise in the Asia-Pacific region, including Japan, Hong Kong, and Australia, as well as its investment banking and equities businesses in Europe and the Middle East. The deal became legally effective on October 13, extending Nomura's global footprint. This strategic expansion highlighted how other firms sought to capitalize on Lehman's disintegration. What legal complexities would arise from such a sprawling divestiture? The liquidation of Lehman Brothers Holdings continued for years, finally concluding on September 28, 2022, after an extensive process of avoidance and preference actions against banks, counterparties, and former partners. The estate enlisted a coalition of law firms, Jones Day, Quinn Emanuel, Deckert, among others, to maximize creditor recoveries across multiple jurisdictions. This prolonged legal battle underscored the far-reaching impact of the collapse. How much of the original debt could ultimately be reclaimed? In the end, Lehman's 110,000 customers were repaid the full $106 billion they were owed, while general unsecured creditors received $9.4 billion, about 41 cents on the dollar. These recoveries, though significant, still left many investors bearing losses. The distribution illustrated both the scale of the bankruptcy and the effectiveness of the estate's litigation strategy. What does this settlement tell us about the ultimate cost of the crisis? Investigations later uncovered that Lehman had used a small firm, Hudson Castle, to shift transactions and assets off its books. Lehman owned a quarter of Hudson, controlled its board, and staffed it largely with former Lehman employees, raising concerns about the opacity of these maneuvers. While the practice was later scrutinized, the exact intent behind the transfers remains debated. How much did these hidden moves contribute to the firm's downfall? Legal challenges persisted when, on February 22, 2011, Judge James M. Peck rejected claims that Barclays had improperly profited from the Section 363 sale, deeming the process adequate given the extraordinary circumstances of Lehman Week. This ruling affirmed the sale's legality despite imperfections, yet left lingering questions about fairness. Does this decision close the chapter on the most contentious aspects of the bankruptcy? From the initial filing to the final court rulings, the Lehman Brothers saga illustrates how extreme leverage, opaque asset transfers, and a sudden withdrawal of market funding can cascade into the largest bankruptcy in U.S. history. While customers were fully repaid and many creditors recovered a portion of their claims, the lingering uncertainty over hidden transactions and the human cost of the collapse remain. So, what lessons does this monumental failure impart for future financial stability?